Ladies and gentlemen, good day and welcome to the Orient Cement Q4FY20 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Krupal Manyar from ICICI Securities. Thank you, and over to you, sir.
Thanks, Raymond. Good evening, everyone. On behalf of ICICI Securities, we welcome you to the Q4 FY20 and FY20 call of Orient Cement. On the call, we have with us Mr. Deepak Khetrapal, MD and CEO of the company, and Mr. Soumitra Bhattacharya, who is the CFO of the company. At this point in time, I will hand over the floor to Mr. Deepak Khetrapal for his opening remarks, which will be followed by interactive question-answer session. Thanks, and over to you, sir.
Thank you, Krupal. Good afternoon, ladies and gentlemen. It's a delight for me to welcome you to, I think, the very first investors call that we are doing in a way, which has been hosted by ICICI Securities. So really thankful to them. Thanks for sparing your time and coming in. And with me on the call are also my colleagues, Soumitra Bhattacharya, who's the CFO of Orient Cement Limited, who actually started with us, I would say, fairly recently in January. He joined us, and along with him, Manish Agarwal, who's anchoring our investor relations from the company. He's also with me on the call. So thanks, Soumitra and Manish, for being on the call.
Yeah. Thank you.
Quickly, let me just, I think most of you, I know the way you people work on that, you would have already gone through, but let me do a quick summary of where our Q4 and full year FY20 has been. A quick summary of that for Q4 is definitely that we have reported the total volumes of 15.75 lakh tons versus a little over 18.30, which we had in the same quarter last year, which reflects a degrowth of 14%. And for the full year 20, again, we are reporting about 58 lakh tons of turnover vis-a-vis 64 lakh tons of last year, which is for the year as a whole, there is a degrowth of about 9%. The Q4, I think up to Q3 is well known that throughout the year we've had a little bit of lag behind the volumes of last year. But in Q4 specifically, the impact, the entire impact is coming out of the COVID-19 lockdowns, which were imposed on 20th. But even before that, in some of the markets, we'd already started seeing the reluctance on the part of the consumers to and some of the channels to keep buying cement. Our estimate that during this time I'm just picking up the numbers from the numbers that we had the last 10 days of the quarter in the previous financial year. If I just assume, and we were actually doing up to, let's say, from 1st January till about 15th of March, if we looked at our run rate, we were actually ahead of the run rate on volumes and also our, I would say, returns or the bottom line compared to last year. Till COVID-19 impact started really playing out. So my estimate of loss of volume on that account is about 225,000 tons of cement, which accounting for the fact that the fixed costs had almost completely been committed and there was nothing that could have been rolled back suddenly. The entire contribution from this 225,000 tons would have actually come to our bottom line. And our estimate of a minimum, I would say, loss of EBITDA in this quarter has been as large as 30 crores. So if we account for this 225,000, I think we were more or less on the volumes that we did in the same quarter last year. And also, if we sort of look at the EBITDA that we have announced of about 130 crores, we were more or less in the same range. The rest of the shortfall in volumes had actually happened for us in Q2 and Q3 when the markets in our side remained a little soft. People have been comparing as to how have our volumes degrowth been compared to the other players in the industry. Well, for the year as a whole, what we understand as of now is there is a manufacturing in the cement quantity manufactured last year. We have a figure of about -1% degrowth in the full financial year or previous year. The two aspects here. One is the aspect that is the production loss that we are seeing, because that is the only figure available in public domain. There's 1% degrowth in production, but my own impression is that on the sales side, the degrowth is definitely more than 1%. Because while the manufacturing had happened till 20th March, suddenly when we couldn't sell, the manufacturing figures look a lot better than what the sales figures would be, because last 10 days because of the lockdown, no sales happened. So even then, our degrowth of 9% for the year is higher than the all India industry. But if we compare our let's say volumes in the last quarter with the markets that we operate in, the fact of the matter is that we have a fairly large exposure to a market like Telangana, in which the degrowth throughout the year has been perhaps the largest. And the one largest single reason for the degrowth in Telangana in this financial year is the function of the fact in the previous financial year, there was a very large project which was under construction by the Telangana government, which is the Kaleshwaram irrigation project, one of the most ambitious irrigation projects that have happened in the country for the last, I think, a couple of decades. So we were a very large supplier, and that not only were we a very large supplier to that project, we were also supplying mostly PPC cement in that project. In May last year, the project got over, so obviously the volumes that we were comfortably getting from the Kaleshwaram project, we missed in this year, because there was no project announced by the Telangana government or any other government of a similar magnitude, which would have made up for the hole that left us with in terms of total demand. So that's the explanation for why our degrowth has been higher than the pan-India degrowth. So that's comment. The other commentary that I think all of you would be interested in is that our company's strength, as everybody knows, is in terms of the efficiencies and our costs and the way we manage these costs. As a result of very strong cost controls that we have always been, I would say, exercising, and I think most of you are well aware of that, the net result is that we have had a practically flat variable cost for the year, and even the fixed cost normally, which suffers a normal rate of inflation, at least because there are employees costs and there are many other costs which keep increasing. Despite all those things, even the fixed costs, we managed to keep completely flat throughout this financial year. Now, this is even more noteworthy if we actually look at a few more facts which are relevant here. One is during the year, because, as I mentioned, because Kaleshwaram project was more PPC, but our sales this year, OPC were a lot higher. And OPC sales are higher means because the unblended cement, it's a more expensive cement to produce. That means we had cost pressures because of the adverse movement of product mix from PPC towards OPC. On that, if somebody is interested in the numbers, last year we had done PPC proportion for us was about 59%, whereas this year it's come down to about 54%. So there's a 5% adverse move in the product mix. And the second big, I think, cost push this year that we had suffered was on account of the challenges with the fly ash from the plants that we used to get the fly ash, which were very, very close to our plants. And when a power plant very close to, specifically I'm referring to the power plant which is close to our Jalgaon grinding unit. In that particular unit, we had to depend on fly ash supplies from a plant which is much further away. So that also pushed our variable costs higher. So despite all this, the costs remaining flat has largely been a result of better efficiencies on the one side in everything, whether it's a heat consumption, whether it's power consumption, all those costs have been managed even better. And second thing which has helped us is our better fuel mix, in which we have wherever for us the petcoke was proving to be more economical fuel to use, we depended a lot more on that. And in the plants where the domestic coal, because we are near to the coal pits, because that particular the coal was actually cheaper than the petcoke, we stuck to the local coal availability. And on top of that, we've also been trying and use as much of alternate fuels as possible to also optimize our fuel costs. So that's the explanation for why our costs look very, very good, because it's a result of quite a few things that we've done. And that is what has resulted in the overall, let's say, financial numbers that I just indicated in terms of 132 crores versus 157 crores of EBITDA in this particular quarter. Because we have had a good quarter one this year, supported by, I won't say good, but at least better than the previous year. The Q2, Q3 also, the profitability remained better. So overall for the year, we are around 400 crores of EBITDA versus about 326 crores of last year. So that's the overall results. Despite loss in volumes, the loss in terms of sales value is smaller because we had a better pricing available to us. And EBITDA is better because of better pricing and on account of the better cost management. So that's on the performance for the year. The other thing which all of you would be concerned with, and I know there are lots of people who've been talking to me, trying to consider how does our debt impact us. Just to give a perspective on the debt right now, our net debt as on 31st of March was approximately 1160 crores. That entire debt is a part of the remaining debt from the 1320 crores that we had raised in the project phase when we started putting the project from 2013 to 2015 September when we commissioned the project. And after that, we have had a 15-year repayment program for that term loan that we have raised from the banks, which is a very well spread out, keeping in mind the what at the project stage were the projections on the total ramp up of capacity utilization, the market development, and all the efforts that were required. So it's a very, I would say, the same repayment program that the bankers had agreed to provide to us. And we keep meeting the repayment program. Under that repayment program in the last quarter, our total repayment of debt is 52 crores. In fact, that's been 52 crores for the full, into 4 for the full year last year. In the quarter that we are in, and in fact in the current financial year, which is now on, our total repayment obligation out of the remaining debt is about 80 crores per year, which is divided into 20 crores per quarter. And that is, I would say, a very comfortable repayment program on top of roughly, I would say, 8 to 9 crores of the interest cost that we need to service. So that's our borrowing from the system, banking system, and our repayment obligations that we carry. Although Reserve Bank of India had already announced that people who need the moratorium, and it's gone on to further say the moratorium is now extended up to August. But I'm pleased to inform all of you that we did not use the moratorium for our March obligations that were paid on time along with the quarterly installment that was due. For the month of April, we have paid the interest absolutely on time, and even for the month of May and June and going forward, there is absolutely no need for us nor any inclination to make use of the dispensation of moratorium that Reserve Bank has announced for people who need it. So our cash flow position as of now very comfortably allows us to project the repayment obligations to be met on time without any support from anyone. The overall commentary, I think also all of you always remain, I would say, curious about the market mix that we carry. Most of you are aware that typically our market mix comprises in terms of 50%, roughly 50, 51, 52% in the markets in western part of India. We sell about 35% in southern part of India, and balance about 10 odd percent goes into one major market for us is Madhya Pradesh, and small little volumes in somewhere in eastern India, or some of the what we call opportunities where somebody approaches us and gives us a good enough price we sell. So largely it is largest is west, and within west is largely Maharashtra. South 35% comprising of 3 states. In that order would be Telangana, Karnataka, and the Andhra Pradesh. So that's on the regional mix that we have. As I mentioned earlier, our PPC has come down to 54%. Our trade non-trade mix continues to be about 50-50. On the so that is for the I would say commentary on the last year to the extent that I believe you people need to know upfront. The second part, I think I'll take another few minutes just to narrate how we believe the current scenario is looking and how have things been from, let's say, after the lockdown started getting eased out by the governments. So the situation with us has been that after the lockdown was eased after 20th of April, we started in phases getting permissions from the government. So first government who gave us permission to start partial operations, limiting the number of people into our plant to just 100 at any one point in time, was the Karnataka government. That was followed up a few days later by the Maharashtra government, where we could resume the dispatches from our Jalgaon plant. And the Telangana plant, which is our largest and oldest plant, there we got the permissions for the last, which actually came very, very early in May. And before that, Telangana government had actually taken a much more conservative stand on allowing industrial activity of people, for people to sort of come into the plants, despite our being classified as a continuous process industry by the central government. So we had that problem. On resumption, our first attempt was actually, as all of us know, on 20th March, because of sudden lockdown, when the plants had to be shut down, we obviously were carrying inventories with us, both of cement and of clinker in the silos, in anticipation of the good sales that we always get in the last 10 days of the financial year. So first intent was start dispatching the cement from the stocks that we were holding. We started with that. As the cement stock started getting consumed, we started only the grinding mills to grind the clinker that we were carrying. And only after the clinker in our stock was consumed, then we thought of starting the kilns. So it's been a very phased restart of activities. As we started the activities, our initial customers were the large infrastructure projects of the Maharashtra government to start with. And thereafter, slowly, gradually, as the governments eased the lockdown a little further by allowing the cement shops to open and start their trade, we started seeing a fairly robust demand from the rural and semi-urban markets from the trade channels. And as we speak, while I would say in the last 2 to 3 weeks, the sales and dispatches have been looking very, very encouraging. At the same time, we are now beginning to see a little bit of headwind coming in terms of demand from the infrastructure sector, where the big change has been in terms of the migrant labor, which was, although throughout the lockdown, they were at the large construction sites where very large EPC contractors were looking after them. But as the Shramik trains and all became available, many of the project sites have lost their migrant labor, and which used to do the construction work. As a result of that, certainly there is a drop in demand from that particular segment. And that is something that we need to monitor as to how long that lasts, number one. And number two, the fact that we are right now leaning more on the rural and semi-urban trade demand is a fact of life. As would be expected, if we take the recent sales, it's one positive development in that particular thing is the fact that when trade sales happen and largely rural semi-urban, that means our mix of PPC has again bounced up. While last quarter was poor, I think so far in this particular few weeks of operation, we are seeing that our product mix is looking healthier. And because of the fact that the supply chains are not quite 100% smoothly working, whether it's incoming of raw materials, whether it's the materials to be dispatched through using trucks or using rakes, there are all kinds of challenges in terms of availability of manpower, availability of fly ash, availability of some critical raw material that you might need. As a result of that, our belief is that the industry is also operating at a level which the environment is permitting right now. And on the other side, the demand being good from the sectors, that means the overhang of supply that normally used to threaten the prices, that pressure has been far lower than what we've seen in the past. And as a result of that, the prices definitely have not come under any pressure, because the supply overhang is not being experienced by the markets. In terms of the challenges right now do remain in terms of, like I mentioned, costs of some of the inputs which have gone up, the freight costs and the availability of the trucks or the rakes to dispatch our cement. And even when we get the rakes, there are challenges because in the cement industry, while most of the other labor is available locally, the dispatches and the loaders, as we call them, a large part of that labor actually has been migrant labor, and many of them have been leaving the sites after being there throughout the most difficult period. Now that the things are actually easier, they're finding this I would say, opportunity of using Shramik trains to go back to their homes and their villages to be with the family very, very strong. So those are the other emerging challenges. The one piece I think which is ongoing also and which pertains to last year and specifically last quarter has been, I think many of you would be aware of the a premium, people are calling it premium brand. I actually call it it's a superior cement which we have branded Birla Even Strong. It's in just about a little over a year's experience, and despite it being priced much higher than I would say any competition, by now we are glad to see that our run rate has now started exceeding 8% of my total trade sales. So why I'm mentioning this is because Strongcrete as a brand and this grade of cement has largely been targeted by us in a very focused manner on the retail segment, where we provide technical support to almost every customer who buys the cement from us to make sure that the mix is right and they're doing the work right with us. With that support, despite very high prices, I think very, very encouraged that very soon we'll be crossing the 10% of total trade sales using the better product that we introduced in the country little over a year ago. And last thing before I open it for questions by all of you, my commentary would be on the fact that we've been talking in the past about our ambitions to grow our capacity from the current 8 million to go beyond that and take it to 14.5, 15 million tons in that range. And we'd also, I think, put up a timeline that it should happen by FY23. Now, as we speak, given all the, I would say, discontinuities in the market, the challenges, the demand not quite sure in terms of how it's going to pan out in which particular market, which segment, because we know the real estate market is going to take quite some time before it bounces back. Even on the infra project side, it depends on the exchequers of not just the central government, but also the state governments as to their ability to be able to fund major projects. There's a lot of uncertainty about where the future will be. So for now, I can confirm to you that whatever ambitions we've talked about in terms of additional capacity addition in the brownfield farm at both the plants, they are on complete hold. Excepting that, we will still keep following it up from the government authorities where we need the approvals to start the work whenever we start. But I believe, and those approvals in any case, even now it does seem that they are at least, I would say, 6 to 9 months away, just the government approvals. So that we will keep doing. But the decision on when do we press the button to say we must get into execution mode to add capacity through brownfield expansions, that will completely depend on how the next few months or maybe a few quarters pan out in terms of pricing, in terms of volumes, in terms of our cash flows. And because of that, how does our balance sheet look to be able to create any growth opportunities that do not create any unnecessary risks for our balance sheet. So we'll be very, very conscious about that. And we will not sort of do anything which the market prospects and our balance sheet does not justify completely. But in the meantime, yes, I think it does make sense to keep obtaining all the approvals that are necessary. The other initiative that we were actually thinking of, whatever else was there, currently everything is on pause mode, excepting we might make some small investments here and there, which are more to sort of in a way give us immediate benefits in the very, very short payback periods. One I would say significant investment which we were ready to launch actually isn't, and which also is a very major cost saving initiative of a waste heat recovery system. Although we are ready to start that project as soon as we can, but again, given the fact that it's nearly 100 crores worth of investment, we would perhaps watch that also for a while before committing such a large capex. And as and when we start capex, maybe the first one to be kicked off will be the waste heat recovery system. Otherwise, a small little investment in terms of making our systems more digital, modernizing a few things which have a very quick. So besides that, we do not intend doing any capex of note for now. we had another initiative in which we were thinking of adding one more brand to the market. Even that will need investments and that will need some registration period. Even that we are putting that on hold now. For the senior leadership team of the company, we have already taken from the month of April salary cuts ranging from 10 to 20%. So the focus largely in this year is going to be cost management, cash conservation, becoming more efficient, and trying to make the best within the circumstances that we are confronted with, because we have no control on the circumstances. The only thing we can control is how we operate, how efficiently we run, and how we minimize our costs, and at the same time keep maximizing the cash that we can generate from our operations. So that, in brief, is the thought going forward. And I would sort of put a pause to my monologue now and wait for the questions from all of you to be able to answer them. Thank you.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Amit Murarka from Motilal Oswal. Please go ahead.
Yeah, hi. Good afternoon, everyone. So just firstly on the demand aspect, very well elaborated about how demand has picked up in different segments and where it is lagging. Could you also help us understand about the outlook for demand, because we keep hearing that while the May pickup has been quite strong, but as of now there is a bit uncertainty around how future will pan out to be. So could you share about your thoughts around demand maybe for the next 3 to 6 months?
Quite honestly, no matter what we estimate today, will be wrong within a week's time. All of us know that.
Yeah.
I would not hazard a guess, and that's why I said the focus that we are putting is on what we are doing internally to remain absolutely lean, remain adaptive, because no matter what we are predicting today, there is no basis for that unless we start seeing the COVID curve really beginning to come down, and everyday recovery is being higher than new infections. I think it's pointless hazarding any guess, and I won't hazard either. That's the mode we are in right now, and not really able to sort of in a way add more than that, because quite frankly, the demand that will exist 3 days later itself is a question mark right now. So it's a question of just hour by hour, day by day, monitoring the situation and responding to it.
Sure. And in the key markets that you operate in, and there has been a good price hike, I believe, in the last month and a half. So could you quantify, because I think it is, is it as much as like 70-80 rupees, and how has the market received it?
See, it's like this. When people talk about 70-80 rupees, they are very large generalities. So if, say, this suddenly has the net realization for the entire industry gone up by 2,500 rupees a ton, I don't think so. Okay. But all I can say right now is that the run rate that the month of May has seen has definitely been better than the exit rate of March. And it's a function of which market you are in. Some of the markets I understand. I don't operate in all the markets I operate, as I mentioned to you. One market largely in West and a couple of markets in South. I believe there are other regions in which I do not operate. There, perhaps the prices have firmed up a lot more. But in our markets also, prices definitely are firmer. And the markets have taken them largely because of 2 factors I mentioned. One is the fact that there is supply overhang, which normally creates a problem, is not there. And also from our side, as I mentioned, the cost side also has gone up.
Right. Fine. And lastly, on leverage, so you have a bit of debt on your books. So what will be the repayment schedule that is there as of now?
As I mentioned just now, for the next 4 years, it's 20 crores per quarter.
Oh, sure, I missed that.
80 crores per year. I have already mentioned that, yes.
Okay, fine. That's all from my side.
Thank you.
Thank you. The next question is from the line of Pritesh Shah from Edelweiss. Please go ahead.
So thank you for taking my questions, and thank you for conducting this con call for us as investor analyst community. Firstly, on the expansion plans which you had pre-COVID, can you just elaborate on what were those?
Is that relevant right now?
I
don't even know when and how we'll go through that. But in a very brief nutshell, the expansion plans included 3.5 million tons of additional capacity at our Devapur, the Telangana plant. That's the old mother plant as we call it, and another 3 million tons was the capacity plan at the Gulbarga cluster, the Chittapur plant in Karnataka. So these are the two things supported by split grinding units wherever the markets are better. So this was the outline of the expansion plan that we had talked about as long as we were considering the capexes.
Okay. And no work had been started even pre-COVID, or there was
no. As I mentioned in my sort of briefing, I haven't even got the government clearances for any of the two sites.
Okay. Got it. And so you briefed about the demand scenario post the COVID. I just wanted to understand that in May, what was the peak utilization which you had achieved?
Well, if you're talking about on day-to-day basis, there have been days when the peak utilization has crossed even 90%. But is that the average, or is it likely to continue for the rest of the quarter? I'm not saying that. Because I mentioned earlier also, there's so much uncertainty. There have been times when we've actually, I'm not kidding, there have been days on which we've had 90%. There have been days on which I have had 50%. It's all a function of whether the labor is there or not, whether you had the fly ash with you or not, whether the petcoke supplies came in time or not. It's a very dynamic situation. So I would request all of you that let's not forget the kind of environment in which we're working. Nothing is working smoothly as of now, right? So when everything suddenly falls in place, we look very, very good, and we start getting excited. 4 days later, suddenly this the smallest of things missing in a continuous process plant can actually hold up the entire plant. I think all of you know that.
Right.
So it's been, all I would say is it's been a lot better than what anybody was actually expecting at this point in time. And my overall impression is that if we focused more on, I would say, sales rather than capacity utilization, my own estimate is that I think bulk of the industry would report for the month of May so far. Again, I'm talking about so far, maybe between 75 to 80% of the volumes that we were doing last year May.
Okay.
Yeah, so that's I think a better way of expressing it rather than getting into capacity, because there was a time when I started with one kiln, then I added second kiln, then I added third kiln, so there were 3 kilns operating at one point in time, right? That time, the capacity utilization was well over about 90%, but that doesn't mean much because if tomorrow I shut down one of the kilns, it certainly comes down to 60%. Yeah. Right. So it's a very dynamic situation.
Anyways, so that's very helpful of giving you that number. Even I was trying to get to that number only. That would help us, forecast how much the next quarter's impact would be, and so on. One bookkeeping one, on the realization, if I calculate for this quarter, I am getting a 9% quarter-on-quarter growth based on your numbers. But I think overall industry, especially in your markets like South, it was a decline. So just was trying to understand why such a high realization growth. Was there any change in mix or sort?
See, there are two things. One, definitely, as I mentioned, the proportion of our premium brand in the last quarter has been the highest. So that obviously takes the overall realization per ton higher. What we're giving to is blended realization, right?
Yeah.
That itself, if we actually net of GST, that itself gives us, I would say, at least 500 rupees a ton of additional revenue per ton that we sell.
Okay.
And the second part is, if you see my freight costs seem to have gone up a little bit. So what we've done is we've actually gone to markets which are a little further away, but the pricing was good. So net of freight, I still make good money. So my realization looks better. At the same time, my freight cost also has stretched a little bit. So it's a mix of, you're right, it's a mix of markets which are more lucrative. And also the fact that slowly, gradually, our Strongcrete brand is contributing a little bit more.
Right.
Yeah.
Right. So 8% of sales, of your trade sales, which you mentioned.
Correct.
That's okay. And what was this last quarter and maybe last year, if you have the figures with you?
No, this 8% that I mentioned is last quarter of last year.
Okay, and current quarter, how much was it?
Current quarter, normally we give figures only at the end of the quarter so far. So I have given you broad general guidelines that you would want to cross 10% very soon.
Okay.
That's what we're working towards. But the rest of the numbers will stay in line with what our practice has been to disclose the exact numbers or exact picture only at the end of the quarter.
Yeah. So 8% was for Q4FY20, right?
That's right.
Right. So I'm trying to just get out what was it in Q3FY20 and Q4FY19.
Well, Q4FY19 we were just about starting. At that time we were just about 2%, I think.
Okay.
But every quarter slowly, gradually it's been moving up.
Okay.
Yeah.
Thank you, sir. So hope you continue with this with your brief and this phone calls. It would be very helpful for us. Thank you, and thank you for the good set of numbers.
Thank you.
Yeah.
Thank you. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Hi, good evening, sir. I have a couple of questions. Firstly, on you mentioned about Kaleshwaram Dam project in Telangana. There was some recent media report which talked about government looking to restart, start the phase 2 of that project in mission mode or something. Is that also we are participating now, or is something some inquiries were started from that project? Yeah.
No, we've been I would say since we are very close to that area of operation, we had a very good contribution, and in the second phase also we look forward to supporting that project in a big way. Right now, I'll be honest with you, my anxiety is the ability of the governments to be able to fund these projects, right? So while the intentions are all there and we are getting prepared for it, how much to expect from that in the next quarter or in the next 2 quarters is something which has become clearer only when the actual orders started getting placed out, right? But certainly, I mean, the announcement of the second phase is definitely encouraging news for us, and we will be there in the project too.
But they also talked about closing some work before monsoons, which is 3 months away, 2 months away.
Yeah, but which is not at the scale that I spoke of, which was in the previous financial year. So whatever work happens on Kaleshwaram, we are one of the regular suppliers, and the EPC contractors who are participating, they are our regular key accounts, right?
Right.
So whatever happens on that, when we close this quarter, I'll share that number with you.
Sure. And on prices, you just mentioned that May prices are higher than March exit. So what is the quantum of increase on pre-GST? I'm not asking post-GST.
I would perhaps you're talking about gross of GST, net of GST?
Gross GST, right? Gross GST.
Gross GST, my guess would be on an average perhaps around 20 rupees a bag. And if you take 28 GST out of that, maybe net about 13-14 rupees a bag, in that range.
Right.
I'm giving a general figure across the markets because, like I said, it's in some markets the pricing is stronger than the other markets depending on how the costs are and how the demand situation is.
Right. And just one question on your trade non-trade mix. You mentioned that 50%. So this was in previous year, probably previous quarter. So how has that moved in like, let's say in current quarter?
In my briefing also I indicated to you, it is higher than what it has been last year. Okay, I did tell you that my PPC, which had come down to 54%, has moved up during the month of May. And because it's PPC and largely trades, obviously my trade mix is a lot more in favor of trade and less non-trade. And given the fact that the large EPC contractors are slowing down in terms of demand, my own guess is that at least till the migrant labor starts coming back, it will be larger trade and PPC compared to what it was last year.
Thank you. Yeah. Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. We take the next question from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good evening, sir, and thanks for arranging this call and giving a chance to ask questions. So first question is, you said you'll be starting with the capex only after getting some comfort on the leverage in the market. So what sort of leverage or absolute debt levels are you looking when you will feel it is comfortable to start the WHRS and then the growth expansion project?
Look, when you say what kind of leverage, see, leverage is also a function of your repayment capability, right? So leverage on its own can't be either good or bad. Let me put it this way. Let me elaborate on that. In terms of if you look at as I mentioned to you, my net debt as on 31st March was about 1160 crores, and today's date, given the good liquidity that we managed to raise during this period, I think it looks a lot better than that. So that part, if I look at leverage, it is just about, I would say, 1.1, which nobody calls it a highly leveraged company, right? At the same time, we also had the problem that in the year FY17 and FY18, FY19, when all of you are aware what happened to the pricing in Maharashtra markets, which is our largest market, our EBITDAs came down, and then the anxiety, let me just remind you, all of you, when you were raising this debt of 1,300 crores to put up the Gulbarga new project, nobody was anxious about it. Anxiety started only when the EBITDA came down. None of you were telling me when we invested the money in 13, 14, 15 that why are you raising so much debt? All of you are convinced that given the kind of EBITDA and cash flows we have, this debt is justified. Suddenly the market conditions became adverse. Suddenly the EBITDA dropped, and then everybody said, my God, you borrowed too much money. And I was asking people, I said, guys, having borrowed 1,300 crores to put up a project which costed us over 2,000 crores, how do you expect the debt to suddenly evaporate just because the EBITDA is evaporated? So my answer to that would be, in terms of raising debt, we've never gone overboard, nor will we go even in future. So if you ask me from the board's perspective, if you say pure leverage, I think the intent would remain that we keep our debt to equity always around 1.5, always. Okay, so that is on the debt equity side. The other side, which we talk about in terms of servicing capability, which actually comes out of the debt to EBITDA ratio, there our intent is not to cross 3. Even when we raise the debt, that time the EBITDA looked well under EBITDA to debt to EBITDA looked well under 3, and that's how the banks also gave us. We have a very good rating. We got the bank's support in terms of good interest rates. Everything has happened. So going forward, also the intent would be to keep debt EBITDA within 3 and debt equity to not more than 1.5 is the let's say current mode in which our board has mandated or whatever mandates we have. So it's not about leverage. It's more about how comfortable we feel about the EBITDA per quarter or EBITDA per year, and that will be a large function of how the prices remain in the market, right? And the volumes, obviously, because without the volumes, you don't make the total money that you need. So it's I think a little more complex question to answer rather than purely from the point of view of how much debt.
Understood. That's fine. Sir, and then with respect to our capex, I missed the opening remarks. So, apart from these growth projects or WHRS, whenever we take, what would be our capex run rate? Just small maintenance capex?
See, capex, to my mind, for a company and for the vintage, because our, let's say, plants are fairly in very, very good shape, we typically don't expect, at least in this year, to go beyond 20 crores. We'd like to sort of, and those are very necessary as some of the small things that I mentioned earlier. So ballpark in that region, unless the market surprises us with volumes and prices, and then we are encouraged to maybe. But even if, let me also tell you, even if we start doing the waste heat recovery project, all of you know the execution time of that, right? So it's not that all that capex is going to get spent within this financial year anyway. Even if I had all the, let's say, reasons to go for it. These projects take time to get built up. Initially, when you start the project, when you start placing the orders for the big equipment, the lead time for some of the equipment is so long that you only end up spending just the advance that you pay against the order. So waste heat recovery construction time is typical 12 to 15 months from the time you start placing the orders.
Yes.
Right, and that's unlikely to happen in the next 2 months or 3 months. So it's not that even if we were to take up waste heat recovery, suddenly the balance sheet start looking bad. It doesn't.
Understand. So just last question, if I may. In terms of cost, any particular pockets where we expecting some tailwind?
The tailwinds largely, I think we would expect from the fuel costs, right? And let's say the overall, I would say benign environment that today exists globally in terms of energy prices. That should definitely be the biggest. Now, energy prices, one is the coal. Now, petcoke, definitely the international, I would say, supplies should be more reflective of the demand supply overhang. And within the domestic market, I'm very encouraged by the finance minister's at least policy statement the other day. Although I know it's going to take maybe minimum of 2 years before any private coal miner can start mining, minimum 2 years, if not longer. But I think that indication will mean that somehow completely disconnected from the global coal prices, the way Coal India Limited or Singareni Collieries or these public sector companies who had a monopoly, the way they had been, just because they signed a new wage agreement with their labor, they arbitrarily jack up the price of coal. I think those regimes will disappear soon. So that works well for the industry as a whole. For anybody who's a user of coal, that I think is good news. On top of that would be the situation with the supply of petcoke. And those are, I think, the major tailwinds that we would expect. I would have expected tailwinds even from the transporters because of diesel cost. But against all odds right now, because the state governments have no other source of revenue beyond liquor. So what they've done to the diesel taxes. I mean, 7 rupees, 8 rupees diesel per liter being jacked up in this day and age is something that you can't explain, but it is there.
Understood. All right. Thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Rabna from HSBC Securities. Please go ahead.
Hello.
Yeah.
Yeah, so just taking forward the previous question on cost, so could you please help me with your fuel mix, current fuel mix?
Look, fuel mix, I think it will be better if you understand how we take the decision on fuels, right? When I say fuel mix, it's a function of what is the most, I would say, efficient fuel mix in terms of landed cost at our project sites, at our plant sites, okay? As I mentioned earlier, our plant in Gulbarga district, we call it Chitapur plant, that plant currently and in the last quarter actually has been almost exclusively working on petcoke.
Okay.
Along with a little bit of what we call alternate fuels which become available. So that is almost 100% because that plant is located in a place where the landed cost of petcoke is a lot more efficient than any other coal. Whereas our plant in Telangana, because it's in the middle of Singareni area where the coal pit, the pit heads are very, very close, petcoke still does not make as much commercial sense as it does at our Chitapur plant, right? So as a result of that, the Telangana plant stays largely with coal and very small petcoke there, because we run 3 kilns in the Telangana plant, and out of those 3 kilns, we can use petcoke only in 1 kiln. The other 2 kilns are very old vintage and trying to modify them to use and start installing the new coal mills which can grind the petcoke and all. Those capexes don't sort of justify the use of the petcoke there because commercially, finally, we need to get the payback periods, right?
Right.
So I think the place which produces more clinker for us during the year, that is on completely, let's say for practical purposes, completely on coal, and the place which is Chitapur, which is a small, just 1 kiln but larger kiln, that is completely on petcoke. As a company as a whole, I would say maybe it works out about 60-40. But it's a function of the plant rather than the fuel mix at each plant. But don't confuse that every plant has a 40-60 petcoke normal
Got
mix.
it. Sure. And secondly, on this premium brand that you had mentioned, which contributes to around 8% of our sales. So could you just quantify the delta in pricing that it enjoys over the other brands that we have?
So we have our internal benchmarks. We link it to our price of the PPC cement we sell because it is in the trade segment and it is a superior product to our PPC cement. We are not putting that as a substitute for OPC cement. Okay. So at any point in time, we try and maintain a premium over our PPC of about 35 rupees a bag.
Sure. Okay.
So that's the quantification.
Great. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Rahul Vira from Abacus.
Hi, sir.
Hi.
Just wanted to understand what would be a fixed cost per quarter after this salary cuts that you've taken?
Look, salary cuts are, let's be honest about it. Salary cuts do not make or mar the fate of a company. It's more a reflection of, I would say, the solidarity and the commitment to the company. The company is going through a difficult period, and we also want as individuals to contribute towards it. Given the fact that the total salary cost in any cement company's the total P&L is small, and even if you take a cut in terms of percentage, in terms of total cost of operations, it's not material. You also know it, right? I mean, the manpower costs are hardly the most important cost on the P&L account of any cement company. So while we have taken, that's more a reflection that our skin is in the game, rather than saying what will save us huge number of costs and suddenly will become 10 rupees a ton less cost compared to what we had last year. Nothing like that. In terms of fixed cost, otherwise, I would perhaps put the figure at about 115, 120 crores, including everything, per quarter. And that is sort of, like I said, inclusive of everything on the fixed cost side.
Okay. And sir, interest cost, is there a renegotiation going for a lower interest cost?
Our interest costs, like I said, are already very, very competitive, and it's linked to the banks. Let's say what our linkage is with the MCLR, annual MCLR. Okay.
Right.
But given the intent that's been expressed by the Reserve Bank of India governor, that he actually wants to reduce the cost of borrowing to every borrower in the country, we have already taken up the matter with the banks that although a reset is not due right now, we certainly want the cheaper credit which Reserve Bank governor is making available to industry to benefit us also. So we are in discussions, we are in negotiations. We haven't got the final decision yet.
Okay. Fair point, sir. Thank you.
The next question is from the line of Jigar Mistry from Orient Capital. Please go ahead.
Yes, good evening. My question was, sir, when you described the 90 versus 50% capacity utilization, you attributed almost entirely to supply side factors. Now, in your opening remark, you said that the infrastructure demand is taking a back seat and the sort of Suru demand is coming back. The question to you is, what is leading to some serious growth in demand like this?
Okay, a good question. I think the dots are there. Let me try and connect them for you. Around this time, if you remember last 2-3 years, there is a very strong news always in the market that in the peak months of summer, April and May, many markets in which we operate in Maharashtra, they have severe drought situations. And many district authorities put a complete ban on construction in those markets. How many of you remember that? This year, we haven't had even one district where the construction has been banned because of lack of water or lack of sand. So that's a big positive. Okay. Second, because earlier also people wanted to do work before monsoon, but it was not permitted by the government authorities. Second has also been the fact that if you today look at any of the company which and look at their sales numbers from the rural markets, you're finding it's the thing which has come up. We all knew that we were sitting with a bumper harvest when the lockdowns were being announced. Fortunately, the governments acted in time. They sort of made sure that the harvesting, not only the harvesting got completed quickly before the migration started. And also, I think they completed the procurement process also in double hurry to save any grief to the rural sector, which has actually put a lot more money in the hands of rural sector. The bumper crop harvested in time, procured by the government very quickly, has released liquidity into the rural sector, because of which almost everybody that you talk to who operates in the rural market is reporting the same thing, saying the demand in rural sector is a lot stronger this year.
True, sir. Are you at all worried that, let's say, a large part of this could be people trying to finish the projects before monsoon, and then the effect of a slower economy and job losses could in fact come back and hurt the demand?
That anxiety is very valid. How that plays out again is a function of, like I said, the typical economics of the rural segment that we're talking about, right? So if we talk about the segment, which is, one is definitely there is always, will the demand in the monsoon months be same as in the months of May and June? Certainly not. That's a given. Every year, every monsoon quarter, we know what happens, right? So I don't think this year monsoon is going to be any different from that perspective. So
but
demand will come down. Sorry
for interjecting. Monsoon to monsoon, you think things could be worse?
In the rural segment, no. In the infrastructure, unless the migrant laborers who are moved back to their villages and they suddenly start realizing that by coming back they've actually made a mistake, because at home again there is no job for them, there is no food, there's equal the misery that they ran away from to go to these urban centers and live like the way they do. I think that we are, and again I would perhaps put a little more nuance into it. Let's face it, there are two types of migrant labor in India. One are people who are in urban cities who are daily wagers, whether it's an auto rickshaw driver, who has to work every day to make his money, to make his living, right? Those people who have run away from almost starvation in the urban centers and who've really suffered in terms of the whatever few weeks they were stuck at the situation in the urban centers, I think they are going to be more reluctant to come back. But if we look at the kind of migrant labor that, for example, companies like L&T or other EPC contractors, these people have throughout the lockdown have been very, very considerate, and they've actually kept their workers not just fully paid, they've also been providing them food, provisions, whatever we could as an industry. I mean, whatever migrant labor was there in my company, I know how well we were taking care of all of them. Those kind of people also, just because Shramik Express is available, they have run back home. This category of people, I think they are going to regret their decision sooner than later, and they would find that maybe they were better off in those doing work on the projects. So it's a question of now hypothesis, which one works. Urban people who provide normal services, migrant labor, they might take longer. But my own belief is people who work for good companies, good EPC companies who have projects and orders in hand, they might come back faster is my hypothesis.
Thank you very much, sir. Appreciate it.
Thank you. The next question is from the line of Gaurav from Morgan Stanley. Please go ahead.
Thank you, sir. Sir, two questions. Firstly, is there any supply-led inefficiencies or inability to service longer lead distance market, which is creating opportunities for pricing? And secondly, within trade segment, will be helpful to get the spread between the rural and urban exposure for you from volume side. Thank you.
Oh, you asked two questions and you confused me. I remember the last one, I forgot the first one that you had asked. Anyway, let me answer what I remember, because that's the risk with asking two questions at the same time, because they're in your mind, but I start immediately jumping to the next one. So in terms of the current demand, I said the out of the total mix that we have of trade sales today, I would say urban centers would form less than 20% and 80% will be rural semi-urban. Okay. And the other question, just remind me please quickly.
Sure, sir. Is there any supply-led inefficiency in the market, or in a way inability to service longer lead distance, which is creating opportunities?
Yeah. See, most of the long distance markets, the entire cement industry tries to service through what we call rakes, that means through railways. When the rakes started coming in, we were having a very good situation. But in the recent past, the availability of rakes is going down, because government having announced the free food for all the migrant labor, and also because they've procured a lot of food grain after the harvesting has been done, a lot of rakes have been requisitioned by the government to move the food stuff, either procurement to storage or to distribute where the migrant labor are and where they need to provide them free food as per the policy announced by the government, right? So, and second is the fact that in the recent past, I would say in the last 1 week or so, with all the Shramik Expresses going all over the place, a rake which should reach from our plant to the destination in about 18 hours, 24 hours. Today, even after 4 days, 5 days, those rakes are not reaching. So if they don't reach and don't get emptied out, they don't become available for the next load. So definitely, last 5-6 days learning is that the railway movement, which actually services the long distance destinations, we are beginning to find problems in being able to transport the cement that those markets need.
Okay, thank you, sir.
Yeah, thank you.
Thank you. Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Could we make it the last, because I think we're running out of time now.
All right. So thanks for the opportunity. So just a couple of questions. Sir, can you highlight which are the new capacities which are getting added in the region that we operate? I'm looking at it from a competition point of view.
Look, as far as I know, there have been a lot of announcements, and all those announcements were pre-COVID, right? Is there any new capacity in our region which is under construction on which the work was started pre-COVID-19? No, not to my knowledge. Nil. And any of the new announcements that were being made by people, including by ourselves, I think my own understanding is that almost everybody is now putting their capex on hold, and we'll need to wait for further announcement as to when do they resume that. But for any of our competitors trying to put up additional capacity in our markets, no, we haven't. We don't have any. So from my perspective, zero.
Okay, so neither Chettinad nor Dalmia nor Ramco, they had announced pre-COVID, but the commissioning will be due in next 6-8 months, even after factoring a delay of a month or two.
Not in the markets in which they compete with us.
Okay, that's great. Sir, my second question is, the ministry had proposed recently changes on the mining regulations.
Mm-hmm.
Does it have any bearing on us and the cement industry?
It will have its bearing, because one of the things which the government is mooting right now is that we can actually do if the demand is there from existing mining lease and environmental clearance. So they are saying 20% if you need to mine more than what has been licensed so far will be put on the automatic route. Right? Yeah. So that means a lot of bureaucracy is reduced, because today if I wanted to do my, let's say, a little more extra production at one of my plants which is more efficient, I was running into a problem of not being allowed to do the mining there, despite the fact that there's limestone and despite the fact I have all the clearances. So that certainly is the one positive. A second positive, typically from our company's perspective, is the fact that we have let's say, a mining lease which had been under a dispute with the Rajasthan government. It is there in the Chittorgarh area. And the basic dispute with the government was that mining lease we had from the time that we were a division of Orient Paper Limited. I'm talking 2012 and prior to that. We had applied immediately in 2013 after the court order came out demerging us to Rajasthan government to transfer that mining lease in the name of Orient Cement Limited, because we become a new company. And till date, the government has not transferred, saying this is a question of transfer of mining lease, so you have to agree to pay the transfer charges. And we've been fighting the government, saying cases like this do not become transferred. These were demergers done in 2012 before the new mining law came in 2015. So in one of the statements, reform statements that have been made by the finance minister, she has made announcements, and we know internally that those kind of provisions are being removed so that state governments do not unnecessarily hold up these transfers. So those things certainly are positive as far as I know. And the third most important, like I mentioned earlier, coal liberalization in India will then sort of enable us to get coal at a fair price rather than an administered price.
Right. So that's useful, sir. Regarding the second point that you touched upon on the transfer of these, sir, what is the cost attached over here? Because there is a royalty payment which is there. I think they are talking about rationalization of the stamp duty, though the numbers are not available over here. Sir, any color over here?
Well, if the numbers are not available, they're not available to me either.
Okay.
It's a government policy to be announced, and let's see what they announce.
Okay, perfect. That's quite useful. Yeah. Thank you so much, sir.
Thank you.
Thank you very much. We'll take that as the last question.
Yeah.
I would now like to
all the participants, I'm really, really thankful to you for all the attention and support that you've given to us today. I would also like to thank the team of ICICI Securities for creating the platform in which we could have a wonderful interaction with all of you. So once again, thank you so much, and I look forward to more conversations as we go forward. And if somebody has had a question who has not had an opportunity to ask today because the call is limited by time, you're more than welcome to approach us, contact us, and we'll be happy to provide you the answers.
Thank you very much. On behalf of ICICI Securities Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect.
Thanks, and
thank you.
Thank you. Bye-bye.
Thank you.
Bye.